A very warm good morning to all of you. I'd like to thank each one of you for joining us today for the Impact Investment Track. And now I would like to welcome Mr. Ramraj Pai, CEO, Impact Investors Council, for his opening address. Over to you, Ramraj.
Thank you, Priyank, and a very warm welcome to all of you, ladies and gentlemen. It's indeed a pleasure and a privilege to be here at the Inclusive Finance India Summit, and providing some of my perspectives on impact investing in India, particularly with respect to financial inclusion. In general, a lot of the agendas around financial inclusion, have a somewhat not-for-profit orientation. We strongly believe that we are seeing the emergence of very strong trends in India, which showcase how social impact investing is able to create very deep social impact as well as generate good financial returns. So I thought I can take the next 10-12 minutes to kind of take you guys through some of the broad trends around impact investing, particularly with respect to financial inclusion, and also give you a little bit of some thoughts around what impact investing itself is, because there's a lot of confusion in terms of what is impact investing, what is ESG investing, and all of these terminologies. I keep hearing that different people have different perspectives. So what I plan to do in this presentation is focus a bit around some broad principles of impact investing. For some of you, it may be very familiar. For many of you, it may not be. Then we'll talk a little bit about impact investing trends in India and how financial inclusion fits in. And then we kind of look at what are some of the non-traditional models which are coming up in financial inclusion and impact investing, which go beyond lending. Because traditionally, we think lending is what inclusion is in many parts. And towards the end, we'll just really talk about where the sector is going and how is it that we as an ecosystem can help the sector emerge stronger from the present challenging conditions that we are seeing. That's pretty much what I want to cover. Very quickly, let me give you a very 15-second introduction to what IIC is all about. Can we move to the next slide with that? Yeah. So the IIC is the India Impact Investors Council. It's a industry body, and we would like to believe we are the preeminent national industry body in India to strengthen the impact investing ecosystem. We are a not-for-profit, and our focus is really to increase the flow of private capital to social impact sectors and build India as a global impact destination, at a very substantial level. That's really what we focus on. We are a member-based body. We have upwards of 47, now 50 impact investors and foundations who are our members. Let's move on to the next slide. Just gives you some sense of who our members are. I mean, not that it's very important, but mostly these are impact funds. They are development sector foundations. Some of them could be, DFIs, some NBFCs, and so on and so forth. And that's pretty much, what the IIC is all about. Let's quickly move to the next slide. Okay. Some broad sense about what impact investing is, particularly in the Indian context, and I thought it's important for us to put this slide. So if you see in this slide, there are two ends of the spectrum. One is the not-for-profit end, and then there is the pure commercial profit end. As you're aware, the not-for-profit is the end of philanthropy, where you make charitable donations with no expectations of financial returns. The other end is the for-profit commercial end, where you say that, we want to make returns and we are not bothered about the other factors. So really, these are the two ends. And a part of the for-profit end includes some of the new themes like SRI, or socially responsible investing, where you do no harm. You don't invest in companies where you believe they are not aligned to your ethics. Typical examples could be companies in the tobacco sector or companies in the liquor sector, depending on each individual or person's ethics or interests. ESG investing, again, you're all very familiar with. Both of these are commercially oriented, but investing in companies who track their performance against key environmental, social, and governance metrics. What impact investing tries to do is really in the middle. It says that we want to create the social impact that the not-for-profit does, but we also want the commercial, we also want the return. Let me not say commercial returns. We also want the returns. So is it possible for us to build commercial solutions while also creating strong social impact? I mean, that's the whole idea of impact investing. Let's quickly move on. I think this is something that has emerged as an asset class. And broadly in the Indian context, we really look at impact investing through three broad perspectives. One is there is an intentionality to make a difference. Second is, are you creating solutions for basic needs of low-income populations? And third is, are you able to scale them up to create commercially viable solutions? All of these three elements are very important from a larger perspective of what impact investing stands for. If you have 1 and 2 and don't have 3, you're not going to be able to generate any material financial returns. If you have only 3 and don't have 2 and 1, then you are just a regular organization which is doing business. Right. Let's move on. So very quickly, we had done a report sometime last year which looked at just a snapshot of what is the size and scale of the India impact investing landscape. This is a sector which has seen impact in enterprises raise upwards of $12 billion. There are 600 plus enterprises which we would want to believe are distinctly socially impactful. And our sense is that upwards of 500 million people have been impacted. The quality and size and scale of the social impact is a work in progress in terms of our ability to measure that deep impact, how much of the impact created. But definitely we can say that these are the number of people who are impacted. How does impact investing really help? This is really through the venture building and early stage de-risking. So many of the companies here, the original funding would have come from early stage venture capital investors who typically, other than the funding, try to support in delivery efficiency, innovation, and leverage philanthropic and blended capital. So many of the small finance banks and other people that most of you are very familiar with, if you go back in history and see, they were all supported initially by one impact fund or the other. And over a period of time, as they have succeeded, commercial capital has really come in. So the whole idea of impact investing is really using the concept of venture capital, bringing capital, innovation, and efficiency to newer business models to make them succeed and scale till such time that commercial capital can come in. That's pretty much a broader snapshot of Indian impact investing. Let's move on. Okay. There's some interesting trends in terms of how the market or distribution of flows in impact investing enterprises has changed over the last say 10 years. So if you can really see the lightest gray bucket represents the non-financial services part of the impact, and the darker colors, which is really the dark blue and the slightly lighter blue, represent the financial inclusion part of the sort of enterprises. So the long and short of what this slide is telling you is that in 2010, almost 75% of all funding that came to the Indian impact sector was financial inclusion based, largely MFI based. If you look at the data today in 2020, though I must say 2020 is not a representative year, primarily because of the severe risk perception that most financial service organizations went through. Nevertheless, I think the trend broadly is that financial inclusion is becoming a smaller element. Other sectors like climate tech, healthcare, education, all of these are becoming bigger. And they are becoming bigger not because financial inclusion is necessarily shrinking substantially. In part, it is also because people are seeing interesting concepts and ideas in some of the other sectors. But that said, 2030 has been a bit of a discontinuity, primarily because of, as I said, some of the risk issues that many people faced. And most people, NBFCs and others, didn't really need risk capital at that point of time. I think they were more into the preservation. So I would say that this gives you a broad sense about how the sector is kind of developing. My view is 2021 data will be somewhere between the 15 chart and the 20 chart. So I think that's more of a steady state. 2020 data is really an aberration, but nevertheless, it is what it is for whatever it is worth. Let's move on. Okay. Let's look a bit at financial inclusion and what it looks like over the last 5 years. So as you can see, financial inclusion really dominates. The other sectors, as you can see in the very colorful chart, are much smaller, and financial inclusion will continue to dominate. But the other sectors are, kind of continuing to kind of grow. And $6 billion have, been invested to support upwards of 150 plus social impact enterprises in this space and have impacted upwards of 10 million marginalized individuals. This is the data of the last 5 years. 2021 has seen a reverse, with financial inclusion has sort of gotten back on track. So I would say that's the broad trend about what financial inclusion related impact investing looks like. Let's move on. Okay. Some very interesting trends here, I think. This gives you the data of, funding in the financial inclusion sector over the last 3 years. And you will see on the left side, 2 bars, there's a dark blue bar and there's a gray bar. I think the gray bar represents investments in organizations which are looking at beyond the traditional lending model. And historically, impact investing in this sector has looked at NBFCs which are into lending, to micro enterprise lending, and so on and so forth, MFIs and so on and so forth. But we are now seeing the emergence of a new segment over the last 2-3 years, which is really looking at how to push the agenda of financial inclusion beyond just giving a loan. And how can you look at rural distribution? How can you look at insurance solutions? How can you look at formalization, especially for small and medium enterprise finance, digitization kind of solutions? And that is also reflected in the chart on the right, which tells you clearly, as you can see, that this is a segment which is growing. It's a very healthy sign. I think it's a very wholesome way of thinking about opportunities in financial inclusion and thinking about the fact that, yes, people do need loans, but they also do need other solutions. I think that's something that we are seeing. Let's move on. But the big message really is really that this is something which is very interesting and exciting. I think we want to think about a category of NBFCs in this sector, which we call as impact focused. We believe these are the NBFCs which are creating robust social impact with strong financial returns. Obviously, MFI NBFCs are part of this, but we have a substantial portion of the NBFCs which are non-MFI NBFCs. They are possibly regular NBFCs, but they may be in several deeply impactful sectors like small ticket micro enterprise financing. It could be second-hand commercial vehicle finance and so on and so forth. This is a sector which, in my view, notwithstanding a few hiccups here and there, has done 4 things. One is that they have created very deep impact. Whether it is in terms of last mile solutions, whether it is in terms of reaching out to people who have zero to thin file kind of clients, zero to low documentation, no documentation. Second is they have fostered innovation. Much of the new models that we have seen for lending, especially in the retail sectors and so on, much of them haven't really come from the banking sector. A lot of it has really come from the NBFC sector, especially the smaller ones. Third is really in terms of resilience. I think no sector has seen more disruptions over the last 20-25 years compared to what this sector has gone through. And every 4 or 5 years, something or the other pops up and kind of there's a bit of a blowout, which really creates a challenge. And the fourth is the financial returns in this space have generally been quite stellar. I mean, you may have an odd company going bad, but I would want to believe that if I look at a 25-30-year-old sector, impact NBFCs have generated pretty substantial returns. Now, as you can see, I'm trying to build here a strong story as to why this is a great sector which can combine a variety of supremely useful things. One is create deep impact, generate great returns, and also foster innovation. If all of this is true, this doesn't really, sort of talk well to our earlier slides where we are seeing a substantial challenge in the availability of funding. Yes, there will still be organizations which are able to raise funding, but by and large, if I look at 2 periods, say I look at 2005 to say 2015, if I look at 2015 to 2020, and just try and see how many new NBFCs are, say, reaching a basic threshold of, say, 2,500 crores or a 5,000 crore threshold, we see the number of NBFCs which are crossing the threshold is falling. And that's the reality. Yes, maybe the bigger ones are growing bigger, and we can say, yes, there have been challenges in the macro environment and so on and so forth. But the reality is that overall, this is a sector which has had a certain set of problems. And I think it is important for all of us, whether we are development foundations, whether we are other social impact investors, to really think about how is it that this sector, which creates, in at least our opinion, these 4, this quadra of returns and impact and innovation and resilience can really be supported. A sector which is facing multiple issues. Let's go to the next slide. Vedant? Yeah, thanks. So I think, multiple issues the sector is facing: access to diversified funding and patient capital. Now, one can say that, yes, if the 10,000 crore NBFC or a 5,000 crore NBFC, 3,000, there will be a bunch of people who will not face it. But by and large, when we talk to the large base of slightly smaller NBFCs, there is a serious challenge in terms of availability of funding, both equity capital, definitely debt capital. There is a need maybe for us to think about a distinct regulatory identity for some of these organizations, much like what MFI NBFCs have. I would also want to believe that cost of funds is a serious challenge. And obviously, it's a little bit of a chicken and egg story of ratings and cost of funds. And, it's a chakra view from which it is not very easy to come out. And I would also believe that there is a risk perception, at least in part. Now, obviously, 2021 has seen some high quality fundraisers and so on and so forth. But nevertheless, many of the smaller NBFCs do face a cautious approach towards them due to their higher perceived credit risk on account of very highly publicized defaults. Whether indeed the default rates in small NBFCs is higher than corporate sector, I'm not very sure, but nevertheless, perception is reality, and that's what it is. So I would believe that just to summarize, this is a sector which is very deeply important. It is a vehicle which provides leverage to the social impact aspirations of the equity which goes into these organizations. So $1 of equity capital into this company can create $6 of social impact. And I think this is a sector which really needs that support, given its relatively, if I may say, high quality track record over the last 25, 30, 40 years. Yes, there have been some challenges, but overall, I think this is a sector which we hope will continue to grow and receive the support from impact investors, bankers, other financiers, and continue to support how this sector will move and create the financial inclusion and support the underprivileged customers who may not have access to the financing that I and you can receive. That's pretty much what I had to present. Unless Vedant, in my memory, I have forgotten. No, I think so. That's pretty much what I had to say. I do hope that these slides will provide a useful kind of segue for the two panel discussions coming up. One on the traditional lending models and how things are going, and the second really in terms of some of the newer models that are coming up on the non-lending side. So thank you again. I think it's been a pleasure to present some of these perspectives. And we hope this is going to be, a great sort of conversation and discussion, and will provide a lot of food for thought in terms of the value that these impact NBFCs bring to the larger financial inclusion ecosystem. Thank you very much.
Thank you, Ramraj, for such a insightful presentation, and thank you everyone who has logged in for this session. Now we'll move on to our next session. And I would like to welcome Mr. Michael Slane, President and CEO Axion, for his pre-recorded keynote address, tracing the emerging opportunities, trends, and new age innovations for impact investment in financial inclusion space. Thank you.
Hello and welcome to the Inclusive Finance India Summit hosted by Access Development Services. It's truly an honor to kick off the summit's track on impact investment in financial inclusion. This is perhaps the largest event on financial inclusion in the world, and a valuable opportunity for investors, bankers, fintech leaders, policymakers, and beyond to come together to discuss the most important issues facing our field, to learn from each other's successes and challenges, and to chart a path forward to ensure India's most vulnerable families and micro and small businesses have the financial tools they need to recover from the pandemic, succeed in the digital economy, and build a more resilient future. I'm Michael Schlein. I'm the CEO of Axion. We're a global nonprofit committed to building a financially inclusive world. We have a pioneering legacy in microfinance and fintech impact investing. Axion is more than 60 years old, and today we're a global leader in harnessing fintech and digital tools to help the poor. Over our history, we've helped to build 170 financial service providers in 55 countries that today are reaching hundreds of millions of people who might otherwise be left out. In India, for more than a decade, we've partnered with many of the most innovative social enterprises. And we're very, very proud of our partners' contributions to the incredible success that India has had in advancing financial inclusion. When it comes to financial inclusion, India is a role model for the world. The number of Indians with a bank account has more than doubled in the last decade, and now more than 80% of people in India have a bank account. More than 1.2 billion people today have a biometric ID, which is essential for government cash transfers. And this program has dramatically expanded access to the formal financial system and public services. The Unified Payment Interface, or UPI, has enabled even the smallest transactions worth 10 or 50 rupees to happen with little or no cost. And this has allowed small merchants, mom and pop stores, and their customers to use and accept digital payments. And according to the new Financial Inclusion Index recently created by the RBI, financial inclusion has improved by 24% in the last 5 years. And this is an index that seeks to broadly capture access to banking services, insurance, pensions, postal services, and more. This progress has a multiplier effect on reducing poverty, growing the economy, and creating equitable economic opportunity for everyone. None of this progress would be possible without the work of leaders like all of you. And your work every day has never been more important than during the last year and a half. Families and small businesses have dealt with an unprecedented health crisis, disrupted supply chains, shuttered storefronts and restaurants, and other challenges that shift day by day. Support from their financial providers in the form of forbearance, flexible repayments, emergency loans, and assistance with new digital tools has been vital to their survival. India has seen some of the worst effects of the global pandemic, and now we need to focus on building an inclusive recovery that leaves no one behind. Axion's partners in India have been working to do just that. Frontline microfinance providers like our partners Subk, Annapurna Finance, and Devara KGFS have begun to digitally transform their operations, collect and analyze data to better understand clients, and deploy new mobile apps and other digital products so that their clients can go digital as well, and thereby start to participate in the modern economy. Inclusive fintechs like FT Cash, Zest Money, and Fisdom have expanded into hard-to-reach areas that traditional providers once ignored. And they've empowered struggling people to get back on their feet after the devastation of the pandemic. These are the tools of resilience. For example, our partner Toffee Insurance provides bite-sized insurance policies that cover specific cases like dengue fever and bicycle theft to allow more people to be protected by insurance. And our fintech partner Agriem has built an e-commerce platform for India's agricultural retailers who, as a whole, provide essential supplies and credit to India's more than 120 million smallholder farmers. All of these have had a real impact on people's lives and the lives of their children. To help show what I mean by that, I'd like to play a short video of a client from our partner Subk. The video shows how inclusive financial services made a real meaningful difference for one entrepreneur and her family, providing them with the tools she needed to make it through difficult times and find financial security.